Hey, what's going on, YouTube? And welcome back to Tech Conversations. Firstly, if you haven't already, make sure to check out Lux Algo. Lux Algo has some of the best trading indicators and AI agents for backtesting, used by over 15,000 traders, including myself. And I just covered one of their premium indicators in yesterday's video, so go ahead and check that out. But right now, if you sign up to Lux Algo by using my link in the description below, you can get up to 20% off their premium indicators. Keep in mind, you can also get 30 days risk-free, so why not try them out? So go ahead and check out Luxelgo. I'll put a link to them in the description below. Also, make sure to check out the Discord, completely free to join. I'll put a link to it in the description below as well. We're almost at 8,000 members, so thank you to everyone that's joined our Discord. Now let's get right into today's video. So today I want to talk about a strategy that could be superior to selling covered calls in certain situations. But before we get into that strategy, we need to first understand what a covered call is and how it works. So for today's video, I'm going to be using a ticker symbol INTC or Intel to take you guys through all our examples here today. And so keep in mind, everything I am showing you here today is just an example to, again, show you how all these different option strategies work. And so the first thing, like we mentioned, we are going to do here is talk about what a covered call is and how it works. So firstly, for you to be able to use the covered call strategy, you need to own at least 100 shares of the stock. Now, I don't own Intel, but let's just pretend I came in here and I purchased 100 shares of Intel and I placed my order here, and now I own 100 shares. So you need to own 100 shares, at least 100 shares of the stock, to be able to use the covered call strategy. So now that we have our 100 shares, the next thing we need to do here is we need to go into the options for this stock. So if we scroll down here on the bottom right, we will see trade, whatever ticker symbol you're on, options. So this is how you get to the options for that particular stock. So let's go ahead and click on this button. And again, this will take us to all the available options for this stock. So once we're here, we need to make sure that we go over to sell here first, because we want to sell covered calls. And we need to make sure that we're on calls here. Be very careful that you're not on puts here. And then, of course, we also need to select an appropriate expiration date. So where do we do that? We can do this here. So right now our expiration date is September 26th. And so here you can, again, look at all the different expiration dates. For today's video, I'm just going to leave it as it is, as September 26th. But again, you can modify this to meet your goals and your needs here. So now we're here, we're looking at calls to sell. And so let's just say that I want to sell the call, the covered call, at the $30 strike. So where do we find our strike price? All the way to the left here on their strike price. So here's the $30 strike. So again, let's just say we wanted to sell this call. So what does that mean? How does this work? So for selling a covered call, we're going to get paid a premium or a credit. We can find that under the price column here. So as you can see, this says 74 cents. That's how much we'll get paid per share. But each contract controls 100 shares. That's why we need to buy 100 shares first. So we need to multiply this by 100. That gives us $74. So for selling this call, we're going to get paid $74. Now, in exchange for that, we need to put up some collateral. The collateral here is going to be our 100 shares. So we're going to get paid $74. We're going to put our 100 shares up as collateral. And so at expiration time, one of two things will happen here. Either the share price of the stock will be at the strike price we selected or less. So if Intel is $30 or less per share at expiration, this contract expires worthless, which means we made $74 and we get our 100 shares back. The second thing that might happen is at expiration, the share price is above the strike price we selected. In that case, we still keep the $74 we received, but now the 100 shares that we put up as collateral will be sold at the strike price we selected here. So our 100 shares would be sold at $30 a share. And so then you can do whatever you want after that. But that's how selling covered calls works. So let's go ahead, let's visualize what that looks like. And we can use Option Strat to do this. So I'll put a link to Option Strat in the description below. This is a really great options visualization tool. So it allows us to visually see things like, profit, loss, things that might happen with changes in implied volatility, all those things. So if we go to build here, they actually have a covered call link here already. So you can go ahead and click on that. And so the ticker symbol we used was INTC. So here it is. As you can see here, we bought 100 shares. Let's just say we bought 100 shares at $29.58, but you can modify here the actual price that you bought the 100 shares at. Our expiration date, again, I just left it as September 26, but again, you can modify the expiration date here to meet whatever it is you're looking into. And then we said, okay, let's just say we wanted to sell the call at the $30 strike. So here is the call we're selling at the $30 strike. So you can slide it left or right to the strike price you select. So now we can see what would happen here. We can visually see what will happen here. So we'll get a net credit here, about $74. We can see what our max loss is. This would happen if Intel went to $0 per share. We can see our max profit here, $116. If you have the premium version of Option Strat, you can see what the chance of profit is according to Option Strat. And then we also see our break even here. And then here we get our P&L chart. So we can kind of see here what our profit or loss will be depending on the share price, depending on the date here. And like I mentioned earlier, you can also play with implied volatility. And you can also see the P&L chart from a different perspective here, depending on what you want to look into here. But I'm just going to leave it as profit and loss here. So now that we're looking into this, what is the superior strategy then? And when would we want to use this strategy? So let me ask you this. Do you run into the scenario where the stock you sell covered calls on does not move at all? Or maybe it only moves up a little bit or moves down a little bit. Do you ever wish in those situations that you could make even more money? For example, here, let's say, Intel doesn't move at all. Let's say it stays at the same share price next Friday at 3 p.m. when the market closes and this contract expires. According to this, you would make $74. But don't you wish that in situations like this where it doesn't really move much, that you can make even more money? Well, you can with the trick that I am about to show you here. So let's go back to Robinhood here. And so we're still going to want to set up everything like we would already. So we're still going to, have to buy at least 100 shares. We're still going to sell our covered call. But now we're going to do a couple of extra things. The first thing we're going to do is we're going to sell another call. And we're going to sell another call with the same strike price and the same expiration. So basically what we're already selling here, we want to sell 2 of these instead of 1. And so I'll show you how to modify the quantity here. Then after doing that, the next thing we want to do is we want to switch over to buy, and we're going to stay on calls here. And so now we want to buy 1 call. And the call that we buy needs to have a higher strike than the strike of the calls that we're selling. So these have a $30 strike. So now we want to buy a call with a higher strike than that. So for today's example, I'm just going to select the one at the $31 strike. So I'm going to buy this call here. And so again, let me show you how you modify the quantity here. So what I'm going to do is I'm going to go to the top right here, and I'm going to go to custom. And so remember, for the calls that we're selling, we don't want to just sell one, we want to sell two. So this is what it would look like here in the end. So we're still going to be entering for a credit here. And as you will see, this can have some benefits and advantages. So let's take a look here. So now I'm going to go back to a new tab here on option strat. And now let's visually see what we just did. And let's compare that to just selling a covered call. So let's go to build and let's go to covered call here. So again, we're using Intel for today's video. Again, let's just say we bought 100 shares at $29.58, expiration date September 26. So again, we're still going to sell our call at the $30 strike. So far everything's the same as we did before, as you would normally do when selling a covered call. But now we said, okay, instead of selling one call, we want to sell two. So I'm going to modify this to selling two calls here. And then we said we also want to buy a call here. And the call we buy, we want that to have a higher strike than the strike of the calls that we're selling. So let's go ahead and add buy call. We only want one here. And so I said, let's just do the one at the $31 strike. So this is what this looks like here now. And so again, we have our regular covered call here. And now we have this new strategy here. So let's go ahead and compare these two here, okay? So firstly, with this strategy here, this new strategy I'm showing you here today, you will notice that the credit you're receiving is higher. You'll also notice that your max loss is less, 28.57, 28.84. And again, this is for this specific example. If we take a look here, max profit 142 compared to 116. So our max profit has gone up. Chance of profit 68% versus 63%. And our break even 28.58 versus 28.84. So a break even is also lower here. So we can see here that we have the potential to make more money. And if we take a look here, let's compare some of these. So let's say the price goes down 2%. With this new strategy, according to Option Strat, you'd make about $43 at expiration. Over here, by just selling a covered call, you'd only make $16. So $16 versus $43. What if it stays flat? If it stays flat, right, with this new strategy, you're making about $103. If we go back here, you're only making about $74. So you're making more. What if it goes to the strike of the call that we sold? So here, with the new strategy, if it goes to the strike of the calls we sold, we make $143, which is our max profit. And with the regular covered call, of course, if it goes to $30, the strike of the call we sold, we'd only make $116. So as you can see, we have the potential to make more money. However, if with this new strategy here, if the share price goes above the strike of the calls we sold, then you'll notice that profit starts to slowly dwindle down. 123, 103, 82, 63, and eventually it plateaus at 43. Versus with just the regular covered call, no matter how high up it goes in price, you'll always have that max profit of 116. Right, so this means that we should really only be using this strategy here if we are pretty confident that it will not go above the strike of the calls we sold. So like I mentioned previously, if the stock doesn't really move, or maybe it just goes up a little bit, down a little bit, this could allow you to potentially make even more money. The other thing I do want to mention here is that we also want to be careful that we don't start to see negative profit on the upside. So if you take a look here, if I instead bought the call at the $32 strike, you can actually see that to the upside here, we would actually lose money eventually. We don't generally want that. We want to be able to still make money to the upside here. And so always use option strat or a similar tool to make sure that everything looks correct here. Now, also, of course, with here, you can make sure to check what happens with changes in IV. If IV goes down or if IV goes up, you can use this slider here on option strat as well. So there you guys have it. This is what I wanted to show you here today. Let me know what you guys think about this strategy. If you have any questions, feel free to leave them in the comment section below. Check out the Discord, link to that in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.